All right, we're back with the Economics of Real Estate podcast. I'm Dylan Silbernagel, that's Matthew Gizzie, and we're going to jump right into it this week. As we promised at the end of last episode, we've been watching a few key economic indicators that are going to give us some hints about what's going on, and especially as we watch home values, home prices, home sales to give our clients better advice. These are the few that we were just checking out recently, and so Matt, I'm going to throw this to you, but the first one we're looking at here is building permits, and we've talked a little bit about this before. You know, the permits are the leading indicator there, and then the housing starts come after with it. And we see, are we holding up to what we're anticipating? And I can see that we're down here a little bit. So talk to me about what that means.
Yeah, so we came in down 11.7% kind of dollar value. The street was forecasting to lose about 4.6% over the last month when it came to the overall value of the building permits. So 11.7 was quite a bit of a drop, especially last month we were up 8.9%. Now with building permits, they fluctuate month to month. So, you know, to see a couple months string of misses would be alarming. To see a month here and there is not too much of a concern. So definitely next month, we're going to want to see at least another uptick, higher than forecast, to make sure that building permits are moving in the right direction.
Perfect. We've got a graph for that as well to give people a visual look at that specifically, I think, when it comes to the starts. But let's move over to the PPI real quick. We're seeing a little bit of an uptick there by just 0.5. What does that mean for us?
Yeah, so the PPI is the producer price index, which measures the change, in the price of goods sold by manufacturers. So the forecast was 0.3% month over month, and it came in at 5%. So I don't know if you've got the chart there for the 5 year.
Yep. Okay, so what we're looking at here, that's housing starts. Let me jump over to.
What was that one? Go back.
Is it the 5 year bond? I'm all over the place here.
I threw you a curveball there. If you go back a couple slides.
Perfect. I can do that.
A little more. Right there.
Perfect.
Yeah, that one there.
Okay, so now here we're looking at the CPI, yeah?
Yeah, so we've got the CPI, and this one's a year over year. And you can see over the last couple months, there hasn't been a massive uptick, but it's also not coming down significantly either. So the consumer price index is definitely being a little bit sticky here. So though it was above forecast, it's kind of been the same for a little while. So we definitely want to start to see this come to the downside a little bit over the next couple months, hopefully.
All right, perfect. I'm going to head back to our front page there. And so we talked a little bit about the CPI, our housing starts. Talk to me about this beautiful big green arrow and what that means, because I think our chart gives us a little bit of a different story, right?
Yeah, so when it came to the housing starts, we were expecting, 239,000 housing starts, which is lower than last month's, which was 242,000. So we actually got 240,000 housing starts. So it was a beat. But when we look at the chart for housing starts, which we'll show a little later, we can see that, since the pandemic kind of started, we're definitely heading downwards on the amount of homes. Back in the pandemic, we were building 334,000. So now we're down to 240,000. So there's a little bit of a lag there. And when we need to build so many houses over the next 10 years, we need to see these numbers remaining strong so that we can hit all of our targets.
Yeah, the further we lag behind here, the more trouble we're going to have in the future when we're looking at the supply and the demand of our housing economy, right? Now, talk to me a little bit about job loss claims.
Yeah, so the U.S. job loss claims came out this morning. Now, the forecast was for 219,000 job losses, but we beat it by a little bit. It was 223,000. Previously, last month, there was 232,000 job losses. Now, if we kind of look over the last couple months, We're starting to see an uptick, but it's not an alarming uptick. I think for the Fed to want to really start to move rates, these numbers are going to need to be consistently getting higher month after month.
Yeah, it's not something that we ever hope for, people losing jobs, but for those rates to come down, we're going to have to see that for the overall economy to justify making that move, right?
That's it. If they want to hit their inflation targets, we absolutely need to get the heat in the jobs market under control.
Yeah, and so again, here's the headline that we were talking about at the beginning. Those permits have dropped 12% in March, and here's what that graph looks like. So again, it's green on the front page, like you said. It's a beat. It beat the forecast, but we are still trending downward in terms of our overall housing starts for Canada. You look back at the peak there in 2021, and just we're kind of on this line that's headed this way right now. When the politicians, everybody, we're all talking about how we need to be going up in this direction. We're going the opposite way currently. So, like you said, it's not a big deal on a month-to-month basis. That's just kind of planning on how the builders go. But we need this trend line to start going in the opposite direction because we are on the wrong path at the moment.
We are. And you know what? We're still mostly higher than prior to the pandemic between 2016 and 2020. We're still on the high side of that. But, when we're bringing in over 1 million people a year to the country, we need to get these numbers higher, and we've got to build a lot of homes, and we need this graph to kind of be heading upwards more than it is downwards right now.
Yeah, we talk about bouncing off some of those trend lines. We need a nice bounce, a little redirection here to get this thing on the right path.
I agree.
Yeah, okay, we covered the CPI already. This is a big one, and I had this discussion with somebody we were hosting a neighbor's sneak peek for a new listing we had last night. And people were just asking about, where do you think the market's going? Is the worst of it behind us? And this is one of the conversation pieces that comes up over and over again, is we have so many people that aren't affected yet by the high interest rate environment that we have, but it's coming down the line because we've got our 5-year renewals and stuff like that. And so taking a quick look at this, these are mortgages that will be facing higher renewal rates at the time. And then we got some big numbers here.
We do have some big numbers here. And we can see in 2023 for the insured, almost 303,000 that had been renewed. But we're seeing this number increase in 2024, 2025. But some of the bigger numbers to increase is the uninsured. We're jumping from 575,000 mortgages up to 722,000, 770,000 mortgages. So all this year and next year, we're going to see a massive amount of individuals who are likely, maybe at a 1.8 to a 2.4, somewhere in that area, mortgage wise, who are looking at 4.5 to 5.5, depending on where they fall, right? So that's a lot of people that have extra discretionary spending that are going to start to be a little bit tighter now.
Yeah, absolutely. And when I look at that and I think about, insured versus uninsured, I go back to all the first-time home buyers that I've ever spoken to that were trying to save up over the 20% to avoid the CMHC fees. And the problem that comes along with that is you can't save as fast as the market was going up, was always challenge number one. But now challenge number two, when I'm looking at this, it doesn't mean that their income was so great that they got to have the uninsured mortgage. Their income may or may not have changed at all. It's just that they had over the 20% down that they didn't need to get an insured mortgage. And there's a big number of them that are going to be coming around with those high things. And it doesn't make us... It's going to be an impact because we don't know if their income has necessarily gone up to justify that higher rate, higher monthly payment at all. It's just that they had the 20% down.
Now, even if their incomes have increased to start to cover some of this stuff, those incomes are currently spending on other things right now. Mm-hmm. So now when they need to refinance these mortgages, all of a sudden that extra $500-$600 that they were spending on food, Uber Eats, or going out and doing vacations or
spending in the economy in any type of way, right?
That might be locked into a mortgage for the next 3 to 5 years. So that's money that's going to come out of the overall economy and be applied against the interest on their home. So that's definitely one thing that I'm looking at and considering is when I see this chart, how much future money is being pulled out of the system for interest payments.
Yeah, 100%. And so looking at this next one, we're now, again, as those payments increase, but we've got a couple different categories that we're looking at here, right? Variable rate mortgages with variable payments, variable rate mortgage with fixed payments, fixed rate mortgage with a term of less than 5 years, and fixed rate mortgage with a term of 5 years or more. And I'm seeing just, again, coming down the pipe and looking what kind of trend lines we're seeing that variable rate mortgage with a fixed payment is just, there's so much of that still to come, right? We've got a little dip here in the variable rate mortgages with the variable payments. We're kind of bouncing a little bit. But talk to me about this one before we move on.
Yeah, and definitely variable rate mortgages with fixed payments is what I've got my eye on. So if we think about it, back in 2021, 2020, they've gotten a mortgage, it's for a certain amount. So regardless if interest rates go up or down, your payment is fixed. Mm-hmm. So this entire time over the last couple of years, these payments are now the interest that they owe is greater than the payment.
Yes.
So ultimately, when they go to refinance, they haven't been paying principal for maybe 2 years,
mm-hmm.
and they might even owe more money against the mortgage because the interest payment was, or the interest amount that they owed was higher than what their monthly payment was. So they're getting to a point where, okay, you need to refi, but you actually owe more money than what you originally started at.
Yeah.
And this is my area of concern. And that's why, even though I am a little skeptical that we're going to see interest rate cuts in June, I think once they do start, they'll have to be pretty consistent, because we're going to have a little bit of a logjam in 2025 and 2026.
Yeah.
And if there's a large portion of these mortgages that are going to be in trouble, we need to get the rates down to make sure that it's not a disaster.
Yeah, I agree. And I think that's one of those things, like, we're looking in 2024, they can get away with it just a little bit more here. But I think in those next coming years, something's going to have to get sorted out before something breaks, if that makes sense.
Yep.
And again, now we're looking at bankruptcies, right? So we see that high there in 2004, and Canada did very good. We trended down and down and down and down, and we're on this uptick right now. So talk to me about this chart and why we included it for today.
Yeah, so this is corporations in Canada that are filing for bankruptcy. And I think the reason we're seeing such a spike here is because, during the pandemic, the government gave out a lot of loans to small businesses to try and keep them afloat. Mm-hmm. And I believe in just the last couple of months, the government came calling for those loans. And a lot of companies were not able to repay all the money that they borrowed and that they lost during the pandemic. Unfortunately, it took a very long time for business to come back to their businesses.
Yeah.
Yep. And a lot of people had to incur more debt, even though the government gave them some loans and some breaks. They were piling on debt to their credit cards and their lines of credits and against their houses to keep their businesses afloat. And unfortunately, now we're starting to see quite a significant increase. I mean, we haven't seen numbers these high since the great financial crisis in 2028.
Mm-hmm. And so tell me real quick, would this apply to an investor that's buying a home in a corporation and then
Yes.
potentially losing the home for whatever reason? Would that carry in there or not so much?
To be honest with you, I'm not 100% sure on that. Yeah, I have no idea.
Okay, well, we'll check that out, because it'd be interesting just to see how that carries over. Always going back to the real estate side and thinking about how people buy properties in their corporations. And we know it's been the investor side that's been hit so strongly in the last couple of years, once these high interest rates really started kicking in and people were over leveraged. So, that's something that perhaps we'll watch for.
And I think the one thing I'll say, Dylan, is that I think the key takeaway from this chart is, we've been in a rate drop environment for years and years and years. And, if we go back to 2004 here, we were losing maybe 880 businesses to bankruptcy, or they were filing for bankruptcy. And when we were cutting rates and cutting rates and cutting rates, this number got smaller and smaller and smaller because we could refinance debts at lower interest rates,
right,
for years and years. And now we're seeing this number rise because we potentially could be in a higher for longer environment, and high interest rates have consequences. And this chart right here is proof of that.
I agree. Coming back to our mortgage side of the discussion, I think what's going to impact more people, we've talked about these rates coming down and when the first cut's going to be, and acknowledging that that's very much on the variable side of things. That is not affecting the 5-year rates and those fixed rates that we're looking at, which is much more impacted by the bond market. And it's kind of interesting because before we would say, well, it's all about the bond market. And we've had some little ups and downs and good times there, but we are definitely still trending upwards, which is kind of interesting as we're waiting for a rate cut on the other side of this thing.
Yeah. And so we had some data points last week in the US, and they were favorable. They looked better than what I was expecting, to be honest with you. And we did see a drop in the 5-year bond to where it is now. We can kind of see where it was peaking out, and now it's come back a bit. But ultimately, when we look at this chart, and when I look at this chart, this is a chart that's still moving to the upside. It's made a higher high and a higher low. So I need to see at least a breakdown, at least where my trend line is, to say, okay, you know what? We've broken down past that lower bottom.
Yep.
And maybe now the market's telling us, okay, you know what? We're going to be seeing some more drastic rate cuts. But really, this is a rising wedge pattern. If we were to put a line on the top of that, this looks very much like a rising wedge pattern, and it will break down at some point. And once we see that, we'll definitely have a better gauge of, okay, when's the bulk of these rate cuts coming? But ultimately, whether they cut in June, July, September, it's probably going to be one cut, 25 basis points. And it's hard to see that moving any type of a needle.
Yeah, I agree. And so real quick before we move on to the next one, as Matt's talking there about a higher high and a higher low, here's a couple of our highs. Here's our high, our second last one, and then the low, and then our next high goes up higher than that last one. So again, trending upwards. Then as we come back down, still higher than our last low. And so I think we're going to see this happening again unless something changes. But this is the trend that we're on currently, and it's important to be aware of that. Now, getting back to our housing market, as we look at, we want to make sure that we're staying ahead of everybody else. We don't want to wait till the end of the month to get the numbers to figure out what we're looking at here. So what we did was we pulled just from the start of May until the 16th of May and compared it from this May to last May. And here you can see quite clearly we're on a decline across York, Simcoe, and Durham. This is all home types, and this is sales volume, and we're down across all categories, all like geographic categories, I should say.
Yeah, and you know what? We had a tough month last year last month, when it came to sales, and we're seeing it again this month. 44% down in York, down 53% in Simcoe. Simcoe's really getting hammered now. Durham down 30% in Durham. They're holding up much better than York and Simcoe, probably due to the fact that their proximity to Toronto. And we go back
to our conversation last week about that 0 to 800 range in Durham and how tight that is. Like they're pretty much bang on at 1 month's worth of inventory, or I think they were even just under a month's worth of inventory, if I remember correctly.
That's right.
So yeah, again, it's here's an overview. We're looking at an entire region, and we're looking at across all home types. So it's an accurate depiction of the market, but it's not a true story for your specific market. That's where you need us to break down and to get into neighborhoods, get into specific municipalities, and again, what we learned from Durham last week, getting into specific price points across the market and seeing how they're behaving differently. Yep. And so now, this one, Matt, sometimes when we look at these, people's minds can just start to melt away with the amount of data that we have on here. So I want to throw it to you, and you can help break us down with some key points on the takeaways. But what we're looking at here is York region. We're looking across detached, semi, and towns. And this is now week-to-week sales starting from March 6th now to May 15th. So why don't we jump into it? Maybe start us off with the detached there and what you're seeing.
Yeah, so on the detached side, we started at 1,578,000 back at March 6th. We saw a little bit of an uptick the next week, but and even into March 27th. So March wasn't too bad for the detached price, but after that, we saw some stagnation, 15.75, 15.75, 15.78, 7.5 again, 80. So we were really holding the line on prices, but something noticeable has happened over the last 7 days. And we went from 1.5 million down to
158.
1.58 down to 1,489,000. And I thought that maybe it would just be an anomaly for York Region, maybe just a bunch of smaller detached sold, which I do think is what probably drove almost a $90,000 decrease in price. Yeah. But as you'll see when we go into Simcoe and Durham, there's been a trend over the last week that I've noticed. And then we'll head into the semis. We started off at 1.22, and we definitely started to come down and make a low at 1,111,000. But I've seen started to see an increase in the semis. They've been coming back to life here, and we're now at 1,205,000. So we are down from where we started.
Yeah. But again,
we are trending in the right direction.
I do think that it's negligible, right? We are looking at median price instead of the mean, which is great. But good to know with such a large sample size that being down just that little bit isn't that bad. But what you pointed out, which was perfect, is that the semis there were trending upwards, and we've seen that. I can say that I've seen that specifically in Aurora, that the semis have been trending upwards in the last couple of months.
Yep. And then we look at the towns as well. We started off at 1,232,000. We kind of got down near the end of March, early April to 1,152,000. Mm-hmm. But we're starting to see a march up from April 24th at 1,145,000. We've marched up to 1,192,000. So definitely, I think the gap between semis and towns, if we can see on this chart, because of how much stagnation there was in the detached price, that the gap just got too wide between the semis and the towns and the detached, and they've started to work their way up. But interesting, in the last week, detached have really started to decrease.
Yeah. And it's interesting, like I always talk about, the gap between the different home types, and it's almost like a caterpillar effect. Like it inches forward, then trails behind. It inches forward, trails behind. And sometimes it's got to go this way, right? Yep. There's that little bit of ebb and flow, especially in the market that we're in currently. And now let's talk a little bit about Durham. And so I'm seeing here, starting back in March, we were at that 1,020,000. Most recently, like you just said, in that last week, I go back to York, that last week, just that little drop. This last week, 965. And when we talk about sales volume being down, we see that reflection there in the price, specifically in that detached market.
Yeah, and we had stagnation in the price as well from April 10th. We were at just under $1 million, under $1 million the following week, down 8,000 from that. And then we did see a bump up in the prior week to last week at 1,045,000. But again, we saw a decent sized drop last week in the Durham detached market down to 965,000. Not as pronounced as what we saw in York, but it kind of confirmed potentially that something bigger is going on in that detached market.
Yeah, and then looking at our green bars here, the towns just staying really consistent.
Yeah.
Right? Like that feels very consistent to me. 810 to 830 where we are now. A couple little peaks in there, but nothing drastic.
No, and right. In a market like this where we're kind of seeing some townhomes build up, to be up $20,000 since the beginning of March, I'll take that over potentially being down, 100,000.
Yeah, and so the semis here, we're seeing. We're up from where we were back in March, marching up a little bit here in that last week of April, right?
Yeah. The one thing I will say about semis is, very few sales in the Durham region. So these prices can definitely fluctuate a little bit more. I think that's why on this chart, we're seeing it being pretty choppy.
Well said.
But ultimately, at the beginning of March, 732,000 and currently sitting at 755,000. So another reason why the move up trade in Durham looks good, because they're holding their ground, and if detached are starting to slip, what a great opportunity.
Yeah, because we're in that spot right now. Now Simcoe, we've talked about this a little bit, and we'll get to it more with the condos. I don't want to get ahead of myself here, but we are seeing that same trend, specifically in the detached market, where we're going down just a little bit, not only from where we were back on March 6th, but also from our highs in that early April, right? Eight
Yeah.
890 kind of being our peak there, and then trending down now to 818 across the detached market. Our semis, we're kind of trending that way just a little bit after a nice push. So yeah, it's kind of interesting. And again, we go back to where did we see a lot of the activity this year? And it was that February, early March was kind of where we saw the push. Even in January, we've got a couple of colleagues that were really on the ball and stacked a lot of listings in January and moved them all quite nicely. And we're just seeing a little bit of that glut. We've looked at the inventory charts as well, right? And we're seeing it stack up across a few areas. So yeah, any last pointers you want to leave off on Simcoe here?
Yeah, the one thing I'll say about Simcoe is the gap between detached and semis uh, is quite narrow.
Yeah, it
And
is. It
and if
is.
you're looking to potentially move up from a semi and your family's growing, or maybe you've got a relative moving in and you want to buy something a little bit bigger,
Mm-hmm.
uh, that jump up right there is enticing.
Yeah. And what I love that you mentioned there is you're talking about all the reasons you would need to move, right? We've been in a very needs-based market as there's been so many changes, which is great. We need to talk to the needs, but I also want to talk to the people that have the ability and can take advantage of opportunity, because I think a lot of the time, in our day-to-day and especially with our home, we don't always think of it as an investment like we do in the big picture, but we don't actively treat it like an investment. And there is opportunity here that Matt's talking about. Like there's such a small gap there. So whether you need to move or whether you could move are two different conversations, but I think they should be had.
I want to make one more point on that, Dylan. If someone, if you need to move because of a life event, because you want to buy a home, we're going to find out a little later in the slides that there is a large amount of people who are waiting for a rate cut,
Mm-hmm.
and they're all sitting on the sideline. And what happens is when those rate cuts come, how many people are going to try and go through the same door? And if you can see an opportunity where you can move up from a town and get much bigger space, do it when others are too scared to do it,
Yes.
or or are trying to chase something in the future. But I can tell you from past experiences is that you're going to have a lot of competition then, and you're going to potentially have to get into a bidding war for that property. And will you get what you want? Maybe you need to deal with a little bit of high interest rate now,
Yeah.
um, but you'll get what you want right
Yeah.
now, I think.
There's so many great quotes, and so I'm just going to kind of amalgamate them together. But when I see fear in the market, I want to be the one that's acting bravely. And when I see everybody being brave and boisterous, I want to be the one that's cautious, right? You want to kind of do the opposite of what the bulk of the markets are doing. And we're seeing people sit, right? So that's why we're finding these opportunities, and that's why we decided we need to make sure that we're having these conversations more openly instead of just us behind doors, right?
That's it. And listen, housing stats, building permits, both heading in the wrong direction right now. We
Yeah,
know coming in the future that the demand for housing, because of population, because of lack of building, is going to be super strong. You
yeah.
got to pick your spots when to buy properties, and in Simcoe right now, it looks enticing.
Yeah, I we shouldn't leave this one alone. When I talk to a lot of people today and they're looking back and they're like, "Man, I wish I could have been around 15 years ago, 10 years ago to buy one of those homes when they were only 500 and now they're going for a mil two." Right? Well, that opportunity is still now. It's still there. You just haven't seen the proof of what 15 years later is going to look like, but that's what it's going to be. Right? So it's your opportunity is now. If you couldn't have bought it yesterday, today is the day for you to buy it. So I
That's
think
right.
that I'm glad that we're having that discussion there. All right, so moving here into April year over year across all home types. This I know we're going to break it down a little bit in the next slides, but you can see what we're stacking here is our sold data, our new listing data, active listings, and then of course median price, and seeing how they all correlate together. So Matt, if there's anything brief you want to mention on this one before we move on to the next slide where we break it down more, what would that be?
Yeah, and the goal of this chart is to kind of show just what active listings, new listings, and low sales will do to prices. So, when we want to see what potentially the future looks like or what today looks like, sometimes we'll look in the past and say, you know what happens when we've got such high active listings and low sales. Now, I don't think you need a degree in rocket science to realize what that is. But
Yeah.
if we go back to 2017 when we hit our peaks, uh, you know, what we saw was a massive amount of new listings coming on in
Mhm.
April, and the active listings we could see were really starting to pile on. And for the next 3 years after that, we saw just what really super high listings and low sales can do to prices.
Yeah.
So if we fast forward to 2022, um, you know, we've kind of hit the peak and we're moving down. We're moving down slowly though, because there still is activity. People
Yep.
still need to buy homes, but we are starting to see those active listings and new listings start to rise. And we need to be mindful and cautious and see just how much this continues to build, um, to see
Yeah.
where the market's heading.
And it's funny too because you look at the sales volume here in 2020, and we look at our average price, and then you come over to 2021 and you see that massive jump across both categories. Everybody was taking that step during those months or during the quarantine years, and you can just see it kind of trail off. And again, this is pretty steady in sense of what it could be. It didn't This drop didn't feel steady. And again, what we're looking at here is York region, so it's not across all home types in the whole market. Because when we look at Treb, we had multiple declining years of sales, right? And York didn't exactly experience that. 2023 kind of came back up just a little bit, not by much, but just a little bit. So, it's interesting. As I think I want to keep everybody's mind open that as you see some of these charts, pay attention to what they are charts of. This might not be your story, but if you're in York, this is the story, right?
And anyone that's interested for more information on exactly their area and what it looks like, they can always reach out to Dylan or myself, and
Yeah.
we can get this data to you so that you're making informed decisions.
Totally. And I think what's important there is we start big when we're looking at your home value. We give you the area, we give you your municipality, your area, and we zoom right into the real comparables for you. And that's what tells the whole picture, because it's not until you get down to that very narrow stuff that you really start to get an idea on what's going on for your product. But you need to know what's going on around you to be able to predict and understand what's happening.